The big story this week in the market is going to be Nvidia. Nvidia stock, a computer chip maker, in particular graphic chips, moving into the area of AI, artificial intelligence. It's been a big runner. But what are you going to do with Nvidia? I am Bagadon at stockmarketcaddy.com. And as a teaching moment, I'm going to show you some of our tools as they are assessing Nvidia. And I'm going to share with you an approach that one might take, not that one should take, and not necessarily one that we're going to take. We might, but let me walk you through it. First, today's date is February 18th, Sunday. Markets haven't even opened yet, and tomorrow is President's Day. I think there'll be at least part of a holiday. So Nvidia and the options market may not be open tomorrow. The futures will be open. But let's take a look at Nvidia through the eyes of Swing Machine. Here is Nvidia right here. Let me highlight it. There it is. Now this is on a monthly basis. Swing Machine went long Nvidia 126 months ago. In fact, I recall when it was first getting long, back in September 30th of 2013. If you had placed $10,000 into Nvidia that month and held it, did not sell a share, you would have $1.856 million in your account. If you did that, congratulations, and you probably don't need any of my help. But if you didn't, what in the world are you going to do now? Do you have fear of missing out? FOMO? Do you put $10,000 into Nvidia now on a monthly basis? The trend is certainly up, but on the fear and greed scale, it's at 90. At 90, pushing into euphoria. So for us, Nvidia is no longer investable for us. I'm sorry. It may go much higher. There will be pullbacks, but based on where it is now on a monthly basis, I can't even begin, even though it may go higher, begin to buy any kind of meaningful shares now. It's a little too late. But let's change our view to a weekly view, and let's see what we see. Now here is Nvidia on a weekly basis. 56 weeks ago, a $10,000 investment back in January of 2023. If you had had the patience, the discipline, the confidence to buy and hold it, you would have more than doubled your money, $10,000 to $25,000. But once again, even on a weekly basis, yes, the trend is very strong, but it's at 90 in close to euphoria. If this pulls back to 552, which would be normal, which would be the mean, a reversion to the mean, I could lose some 25-30% of my initial investment if I was to make an initial investment. So what do I do? Well, the only way for me to consider putting any money to work on Nvidia is to trade it. And to do that, I'm going to knock this down to a daily view. And what I need to consider is what's going to happen this week with earnings. And I have no idea. Now, Nvidia, 71 days ago, had I put $10,000 in, I'd be up 58% or 5,800. The trend is very strong. And in terms of the fear and greed stage, it's only at 60 on a daily basis. It could go much higher. And in fact, we have a little bit more of a tool over here that can show us, let me bring this into view. I'll try. Bear with me. Let me slide this over. And we can see the pivot information. She's trading basically right on the pivot at close to 730 some odd dollars is the pivot point. She's trading right in the middle there. She could go to 745, but she could pull back to 714 easily if she misses earnings. So what to do? She's trading at 727. If I buy 100 shares, it would be 72,000 some odd dollars. If I take a 10% haircut, if she misses earnings, I could lose $7,000 to $10,000. That's not so good on the earnings call. If I short it, same thing. I've got to have the available capital. But if she blows out the revenues and blows out the earnings, I think it'll be tough to blow out the revenues. She's trading at about 40 times revenue. But if I short it and she blows it out and goes up 10, 20, 30%, gets into some sort of parabolic blow off, I could lose $7,000, $15,000, $20,000. That would not be good. Now, if you are comfortable with options, I could do a couple of things. I could buy a call option, and she's trading at 720, but let's say I buy a call option at 730. How much would that call option, which is a bet that it's going to go up, if I buy a call option going out approximately 38 days, let me bring into view the option chain. Here is the option chain. And let's drop down and get the strike at 730. If I was to buy a call option going out, let's get this the time frame on this, 38 days, a 730 call would cost $55, $56. It would be about $5,600. Now, if I buy this tomorrow, if the market's open, or Tuesday before earnings, I will be paying dearly for it because the implied volatility is going to be very high because of the earnings call. And I may get the direction right. She might blow out earnings, but as soon as earnings are out, that implied volatility is going to get sucked out of the option because that implied volatility is going to go down, and I may not go up enough for me to make any appreciable money. Also, if I buy a call, the probability of profit, the probability of any profit, not the probability of profit, but the probability of outcome, but the probability of profit is less than 33%. The same is true if I wanted to go on the dark side, and I think that the top is in and it's a bubble and she's going to go down. Same thing, if I buy a put, I'm going to spend $5,600. It's going to cost me $100 even more. As soon as the earnings are out, the implied volatility is going to get sucked out. The value of my put could very well go down, and I would have to have a move, in excess of 56 points going down to even get into the money. What to do if I want to do anything in front of earnings? Now, you could wait for earnings to come out, let the stock go up or down, let the implied volatility get sucked out, and then place your trade from there out 35, 40 days, which might be a safer, smarter bet. What I'm inclined to do is this. Because Nvda on a weekly, monthly basis is in near euphoria at an extreme level, I'm inclined to think that regardless of what Nvidia does with earnings, and there could be a pop-up for a day or two, that the probability is that Nvidia is going to come back. And even on a daily basis, she's at 60. But I'm not really crazy about shorting Nvidia because it has such a following. And even if it does come back, there might be some ready buyers there to gobble it up. And if I'm placing a short bet or with puts, I may not really have the opportunity to profit that much. So what I could do is this. I could come in and sell a call at 7:30. A call at 7:30. I meant to move this down a little bit so you can still see this here. See Nvidia. So she's trading at 727. When the market opens, if I come in and I sell a call at 7:30, the market will pay me approximately $5,600 in essence to be short Nvidia. But if Nvidia blows out and goes much, much higher, then I have unlimited risk because I would have sold a call at 7:30. So what I could do is go down, watch the delta. If at 7:30 the delta is 0.53, what I could do is sell the call at 7:30, come down on the delta, right here at 8:20, and buy a call at roughly $26. Now, in keeping with this example, let us show you what the math would look like. We sell a call, a 7:30 call. We receive a credit of $56, or 100 shares times 56 would be $5,600 for the contract. But if I merely do that, I have unlimited risk, and that I don't want. So I could take a portion of that credit and go further up on the delta as we showed you and buy a call at 8:20 and pay $26 a share, or $2,600 from the $5,600 credit. What would that do? That would provide me a maximum gain of $3,000. What is my maximum risk? Well, if between now and the expiration date of 38 some odd days, Nvidia trades above 820, I cannot lose above 820. But how many points are there between 730 and 820? There are 90 points. That would be 90 or $9,000. But I still received a credit, so my maximum risk would be $6,000. That is an example of a call credit spread against Nvidia going into earnings. It isn't what I would do. Well, wait a minute, bagger. Why'd you go and show me all that? Because I wanted to show you as an example. But if you remember in the early part of the video, I said I'm really not on getting short Nvidia. And by selling a call credit spread, I do define my risk. I do think it's tempting, but I'd rather not be shorting a story stock. So what else might I do? Let me show you. Okay, so we don't want to sell a call credit. We don't want to sell a call, a naked call. We don't want to sell a call credit spread because we really don't think it's wise to be short Nvidia, even though we could define our risk. That would be the best thing. Now, Nvidia is trading at 727, roughly 730. So assuming the market opens, one of the things that we could do is, if she's trading at 730, come over on the put side and come down on the delta. The likelihood, the options market is telling us that the likelihood that Nvidia over this time frame, 38 days, trades at 670, the likelihood is that it's less than 30%. 70% chance that it's going to be above 670. So what if we sell a put? We come over here and we sell a put. You might think of it as being synthetically long, but it carries some risk. What is that risk? What if Nvidia misses really badly and it goes down to 650? It goes down to 600. We would be obligated to buy the stock at 670. That wouldn't be so good, and our risk isn't really defined. We don't have unlimited risk. We have the unlikely, the very, very unlikely risk that Nvidia goes to zero, so it's defined and it's very unlikely, but it still could go down quite a bit because it's so extended. So what we could further do is, if we sell the put at 670 and receive a credit, which we're going to describe this out as we did earlier. We'll write this out for you as an example. We'll call it roughly $2,900 in a credit. We could come down on the delta. Here we are at 30. And we could come down to, say, 20. And what might we do? Buy a put. And we would come here, hold the button down, and we buy a put. That would define our risk. Because if Nvidia goes below 630, we can't lose anything more. But it's highly unlikely. There's only a 30% chance, based on what the options market is saying, that Nvidia is going to get to 670. And there's less than a 20% chance that it's going to trade down to 630. So what might that trade look like? Let me show you. So let's draw out this trade. We sell a 670 put, which is a synthetic long on Nvidia going into earnings. We receive a $2,830 credit, which means we're on the hook to buy 100 shares of Nvidia at 670. Now, if she beats and moves higher, beautiful. But if she doesn't, now the likelihood priced in from the options market tells us the likelihood that Nvidia is going to trade down to 670 in the next 38 days is less than 30%. So we have the probabilities on our side. But we do want to protect ourselves because we are traders. So we take a portion of that credit and we go downstream. We go down to 630. And what do? We buy a put. And the cost of that put is still expensive now because it is in front of earnings and it is implied volatility. And we pay $1,685. What does that do? Well, our maximum gain is 1,145. And we want to be with the cheering throngs and the madness of the crowds. We want Nvidia to run up and never come close to 670. But if they miss and they come down and they go to 600, they go to 500, that wouldn't be good. But that put that we buy at 630 protects us, and our maximum risk is $2,855. So we're risking $2,855 in this instance to make $1,145. The probabilities are over 70% that it won't come back that far, but it's a probability. And it's much less risk than if we sold the call credit spread. But is it still a good trade or good idea? So the question is on this trade, and let's bring this further into view. A 670/630 put credit spread, which is what this is, going into Nvidia earnings, and this date on this would be March 28th. Is this a good idea? Well, we're more comfortable doing it on this side than, as we said on the call credit side. But what we also like to do is to subtract 670 from 630, which is 40 points. Divide the maximum gain, which is 1145, by that spread. And that comes out to approximately 28%. We would like to have a gain. We would like the gain to be at minimum 30% of the spread. So it's not the most optimum trade setup, but for us, it would be palatable. It would be the only way that we would trade Nvidia going into these earnings. Once the markets are open, we would do the best we could to get the prices we need. We might be able to do a little bit being patient. Or we simply sit on our hands, let the earnings roll out, let the implied volatility be sucked out of the market, and then come in and maybe sell that call credit spread if Nvidia does in fact blow up to 800 or 850 and do something really even crazier. Folks, I'm bagging on. This is StockMarketCaddy.com. We're not specifically recommending that you buy or sell anything or that you put on this trade with Nvidia. We are not. We are showing you what is possible, giving you an example of how one might use our tools. When it comes to trading, unlike betting on the Super Bowl, anybody who can fog a mirror can bet on the Super Bowl. You can bet high or low. You can bet on these things called parlays, I think they call them, betting on how many yards somebody might run, all these different binary gambles. We're not gamblers. We're playing the probabilities. And the probability of profit by selling a put credit spread, the probability of profit, not probability of outcome, is about 66%. Whereas buying the call would be very expensive and the probability of profit would be less than or be at about 33%. So you can have all the tools in the world. More important, more valuable than any one of our tools is the education that we provide with it. In fact, I'm going to say that the education is much more important. To that end, when you join as a monthly member, you come with the education that you have, and I can't possibly appreciate what that is or is not. I will certainly do my best to help you around the edges, but if you never call, never check in, never ask many questions, really hard for me. If you choose to become an annual member, before you become an annual member, you must go through what we call a Q school. That is the time that we get to spend with each other very intensely over 3+ weeks to discuss the details of such a trade as we have here and so much more. We want to provide you not just the tools, but the education to use these tools and to be able to make adjustments. It is no good to make just one trade. No one trade should make you rich. No one trade should make you poor. Once you recognize that, you'll realize that you have to be able to go into the market day in and day out, week in, week out, and extract cash flow. And if you do that without a proper education, it's impossible to get confidence. And if you don't have confidence, they're going to take your bread away. We wish you the best. The other challenge here is we will come back and report on the outcome of this trade. But because it's stretched out over 38 days, when you trade options, it takes much more time. And time is on our side here. But it takes much more time for the trades to play out. As opposed to trading futures intraday, we get some immediate feedback. We get immediate tactile response. And we can build on that response, that experience, and that confidence. With options, it does take longer. Therefore, you must be more patient, you must be more disciplined, and you must have a very mature perspective about what you're doing. We certainly are. We wish you the best. Good luck for all of you this week, and we'll be watching Nvda with everyone else on Wednesday. Good luck.